When there is a stock market sell-off, this is how I initially felt, sick to my stomach. Now, when there are sell-offs, this is my new reaction, happy that I can finally get some deals. I'm going to go through 4 points that I use to evaluate my portfolio when in a risk-off scenario. It gives me comfort to know that I've prepared the best I can for any stock market environment. This isn't a video about time in the market, as I do understand that time in the market is worse than overall time in the market, as this graphic shows. Missing the 10 best days in the market from 1995 to 2024 would result in a 54% gap. However, from a market psychology perspective, it gives me comfort in having cash available when deals arise and feeling the same conviction on my holdings even if the stock sells off. If the bull market continues, I still have 70% of my portfolio in high growth stocks with a target return of greater than 15%, so I'd still be rewarded handsomely and be beaten the S&P. My greatest investor, Warren Buffett, has a cash position available that he adjusts depending on the overall macroeconomic environment. With that established, let's go through point number 1 to prepare for a market sell-off, which I call take out the trash. It's obvious that in a sell-off, meme coins or meme stocks won't do well, so if I had any of those, I would get rid of. For this statement though, I want to find the companies that when pressure tested, no longer have the same thesis I had when I originally purchased. One example of this is Moderna. This was a company I had at one time been excited about. I thought their COVID shots can give them a nice recurring base, and their RNA technologies gave them lots of optionalities with an exciting pipeline. The thesis at the time seemed sound, but when Moderna started slashing R&D budgets, experiencing delay after delay to their pipeline, and pushing out profitability targets by years, this caused me to reevaluate. For me, I have a concentrated portfolio of around 11 holdings, so for me to hold those companies, I need to be able to answer these 3 questions in a concise elevator pitch. First, why am I holding this stock? Second, is the company on track to meet those targets? And third, what are the risks to the business? So for example, New Holdings is one of my current highest conviction stocks. I own the stock because I believe New Holdings can continue to grow in their current countries by offering more services. It can scale into more than the 3 countries they are in today by excelling with their lowest cost, best service model. So far, they're on track as user count continues to grow with over 123 million members and an 83% activity rate. Now, the risk to this business is macroeconomic volatility in Latin America, but I believe they can replicate the success of Mercado Libre, who dealt with these same risks and are dealing with them today, by growing with a focus on having a financial focused super app. I like this pitch, and we'll reevaluate New Holdings with the same 3 questions after our next quarterly update. Second point to prepare myself is I want to make sure that when the downturn happens, I am ready to pounce. For this, I've prepared price targets and position sizing beforehand, including for the stocks I already own. Key thing for me is my price targets aren't necessarily based on a stock price being 20% cheaper than I paid for before. No, rather it is more fundamentally focused, such as buy local when around a trailing PE of 25, and again if it gets to a trailing PE of 20, or buy a third position of Samsara when at a trailing price of sales of 12. Making this list beforehand just helps me stay grounded and not act emotionally to buy a stock I've never heard of, but just saw that it sold off 40% in a day. For me, prep work and research is key. Now, before we go through my last 2 checks, please review the disclaimer in the notes below. We are not financial advisors, nor anything we say should be taken as financial advice. Also, if you like content like this, please help us out and click a like and a subscribe. Usually we cover twice per week analyses on the most long-term and innovative focused companies. Now let's go to point number 3, avoid the fallen knife. Doing the first 2 points of asking those 3 questions when evaluating a current portfolio, and second, making a set watch list with price targets ahead of time, will drive point number 3, to avoid the fallen knife. Peloton is a good example. In 2021, Peloton's stock started its over 90% sell-off from its peak, and its price-to-sales ratio dropped from 15 to currently is a sub-1. Back when gyms were shut down and people were itching to exercise, the thesis of Peloton revolutionize in fitness seemed plausible. However, seeing its revenue decline and excess inventory dilemma, I wouldn't touch this, no matter what or how reasonable its valuation looks. Contrast Peloton with one of my favorite holdings, Mercado Libre, which I have bought 3 times. The first position I bought was around $1,082 and at a price to sales ratio of 17. I then watched the stock go up 50% in 2021 before it started selling off in late 2021. I then made my second buy at a higher cost basis of $13.44, but the price to sales ratio was much lower at 9. I then made a third purchase at around $800 and a price to sales ratio around 4. Now the difference between Mercado Libre and Peloton can be seen here in yellow. Despite the stock price decline, I felt Mercado Libre's thesis of democratizing commerce in Latin America was fully intact, as its 12-month trailing sales continued to increase. Knowing this was my thesis beforehand helped me understand this would be a multi-decade tailwind, where people buying exercise bikes can go away in the case of COVID ending and gyms opening back up. So key takeaway is finding deals when the market provides them is a phenomenal feeling, but I need to make sure that these companies still fit my framework as long-term additions. Fourth point I factor when preparing for a sell-off is to make sure that all my holdings in watchlist stocks still abide by my framework of having large total addressable markets and strong secular tailwinds. I believe strongly in the growth of cybersecurity spend and emerging market digitization, so much of my portfolio and watchlist is concentrated in these. Now, conventional wisdom has taught me that I should cycle into consumer staples when fearful, since when times are tough, people will cut back on things, but they will continue to buy toothpaste. I do not believe in the sector rotation strategy, as the sector rotation strategy would mean I'm trading and constantly just chasing sectors after CNBC already publicizes them, versus instead buying a stock and letting my long-term winners grow. The data shows, too, that investment in XLP, which is a consumer staples ETF, to diversify will underperform. Looking back in January 2020, before the COVID sell-off, both consumer staples ETF, XLP, and SPY had both sold off during COVID. The difference is SPY has come back faster and has excelled in this bull phase, over 4x in the returns of consumer staples. Thinking, well, I just timed the market and have held consumer staples during the sell-off and switched to growth during the bull run is overly optimistic. Timing the market is nearly impossible. Instead, the best case is to have my holdings in ones that I love to have long-term. In summary, let's go through the 4 parts in plain language. First part is to question all current holdings to evaluate if the thesis still sticks. Second is to have the buy list ready to stay unemotional as deals arise. Third, when stocks sell off, ensure that business fundamentals are still solid, as can be measured with hard data like revenue and profit growth. And last check is to ensure that I stick with companies that meet my 5-point framework, which have secular tailwinds. Doing these 4 steps will help me psychologically avoid impulsive actions during a sell-off, which, until it comes, I'll be happy with my high exposure into the stock market as is. With that said, thanks for watching. Please help us out and click a like and subscribe as we cover these long-term innovative companies to add to our community portfolio. Until next time, happy investing.